Nathan, thank you for coming. So I will start from a quote of David Harvey from his book, The New Imperialism, that was published in 2004. And David Harvey says this: debt crisis within particular countries, with 2/3 of IMF members experienced a financial crisis after 1980s, some more than twice. And now could be used, however, to reorganize the internal social relations of production in each country where they occurred in such a way as to favor the further penetration of external capitals. So I wanted to start from this quote because it says a lot about how many states, as you said, 2/3 of IMF members, and that's basically all of the countries in the world except the richest ones have had debt crisis. So Nathan, can you explain to us what are debts and how we measure them, why they occur and why they rise, and also what are the usual misconceptions about debts?
Yes. So thank you for inviting me. So first on this question, what are debts maybe and how they are measured? Yeah, I think it's important to understand maybe the basics here, that when you talk of sovereign debt, you're not talking about the same thing as when you talk about household debt or something like that. Sovereign debt is linked to a state economy which has millions of workers producing wealth that can then be used to repay the debt. How it's measured, I think it's a very interesting question because it's extremely subjective. I mean, okay, you can talk of the absolute measure, like how many billions or millions of dollars or euros the state owes, but most of the time you try to compare it with things that can be comparable. So you talk of debt expressed as a percentage, as a share of GDP. So for example, the US will be, I don't have the figure in mind, but will be like 10 times more indebted than France, or 30 times more indebted than Greece in absolute terms, but in terms of share of the GDP, it's not the same. And we know that the US has the financial means to repay the debt, and has the geopolitical means to go abroad to make imperialist wars in case they didn't have the financial means or whatever. So yeah, it's interesting. But then I was saying it's subjective because if you look at the rules of the Eurozone, for example, or the general principles elaborated by the IMF, you can see that they say, okay, above this measure, I think both for the IMF and the Eurozone, maybe 60% or something.
Yes,
like that.
I think it's 60% in Eurozone. For sure.
They say above 60, when your debt is above 60% of GDP, then there's a huge problem, is what they say. And then you're like, okay, you wonder where does that figure come from? What does that mean exactly? What does it refer to? And I think even they don't have the answer. I think they just somehow make some calculations, chose that measure as a random thing. Because if you look at it, the debt of Greece before 2010, before the first bailout, was at around 110% or something like that of GDP, which is the same as France or Belgium nowadays, or which is lower than Italy nowadays, for example. And yeah, and yet there's no external intervention in France or Belgium or Italy. And another thing is also in the Eurozone they have fixed this measure that, like, okay, above 60% it's way too much, but the first ones who broke this rule were Germany and France, and the core countries of the Eurozone, and yet it was never a problem. So it's really good.
Yeah. So can you talk more about who profited from this and who are the lenders usually, and was it really possible, you know, to do, for example, austerity measures like we did in Serbia? For example, in Serbia, there was in 2013 there was talks about bankruptcy, and they said, you know, our debt was close to, well, we were close to bankruptcy, and therefore we had to do, you know, austerity measures. We have to tighten our belts, as it is popularly said. And for over 10 years, we had 10% of wages and pensions cut off, wages in public sector. And not only that, but the akcize, or what you say in Serbia, or as I found in English, it's called excise, on certain goods skyrocketed. So fuel prices went up, tobacco, and so on. And state was really profiting from that. And that transformed to public unrest, and we had protests in Serbia over fuel prices this spring. And so, who decides that we are going to, that the people have to tighten their belts? What are the institutions that, you know, do this, and who, we know some of them, but can you explain us more on how they function?
Yeah. Yes. So indeed, to put it short, what we usually say in the CADTM, in my organization, is to put it short, we say that we believe that debt is being used as both means of wealth transfer from the poorest to the richest, and as a means of political domination, of political subjugation. So indeed, there you can see the question of like, why such a thing, and who benefits from it?
Yes.
And yeah, I would say that there's a whole architecture of the global economy that was set up in after the 70s crisis. So in the 70s and the 80s mainly it started, and maybe we can go back to this quote by David Harvey, who was saying how much the debt crisis was used to restructure the internal economies. I think it's very much true. I think it grasps in a very clear manner what the debt crisis were, how they were used, and I think it relates to a concept also used by David Harvey in this book. I don't know whether it's the first time he theorizes it in this book from 15 years ago, the theory of accumulation by dispossession.
Yes, it is.
By dispossession.
Yes.
I think it very much applies to the concept of sovereign debt, and to the concept, to the results of the sovereign debt crisis, or crises in the plural, that happened since the 80s. So, if you look at the first crisis, happened in the global south in the 80s, and I think it's very interesting. It's very useful to look at it, because basically what happened from the 80s, so in the 80s and in the 90s in the global south, I think was basically laboratory politics for what would happen then, for example in Greece in the recent years. So the infamous consequence of the debt crisis in the global south was called structural adjustment program. And now I need to say, okay, I'm talking about the global south. I never knew where to put Yugoslavia in that, and I know that Yugoslavia was one of the first countries to implement a structural adjustment program in the 80s. So what are those programs? They basically they are political programs, political economic programs that helped impose what was later called the Washington Consensus. Basically a whole set of neoliberal measures of liberalization of the economy. So basically, okay, there's a debt crisis. The state can't pay. The state is bankrupt. What happens is the IMF stepped in and said, okay, we will lend you some money, or we will grant you some debt relief, but not a debt relief as in a debt cancellation, just enough so that you can continue to repay the debt. So that's what they offer you, or that's what they offer the debtor state, and then they say, okay, we offer you this, but on the conditions that, and the conditions are this liberalization of the economy, which entail many features, different features. I guess the main one was the privatization of key sectors of the economy. Mainly we can talk of energy, water, communications, the banking sector as well. I think there's a whole lot of countries in the global south which still had national banking sectors, and I think it was a good thing, in fact. And since the 80s, still nowadays, they are being privatized. And basically, the privatization of the economy would open up the economy to foreign capital, foreign capital which was available from the core countries where there was over-accumulated capital. And where the core countries were thus exporting the capital from the core economies to the global south, seeking for higher profitability because of lower labor costs, lower wages, basically, because of less regulations in the global south, because of less labor organization, or at least maybe not less labor organization, but more repression against labor organization, etc. So that was one thing of the structural adjustment programs, those privatizations. Other aspects were the removal of tariffs for trade, and then later on the implementation, and still nowadays, the implementation of free trade agreements. I would say these are the two main measures, but then also a whole lot of other measures, such as adoption of floating exchange rates, variable interest rates, the decrease of public spending in social sectors, but also more general, the decrease of public investment. And because of these structural adjustment programs, dependent states became even more vulnerable, I think, to international competition with the most industrially advanced countries. And those countries in the global south were prevented from investing in the public services. Also, they were prevented from investing in the productive economy, and therefore those programs, they condemned the populations there to permanent precariousness, permanent poverty, and also they condemned those debtor states to permanent debt. So basically, what was supposed to be a solution to the debt crisis became a way to trap those countries in a debt trap. Yeah, and there's also the liberalization of trade, but I guess I told you.
Yes, yeah. So, but this, okay, so you explained the core countries profited the most, but can we talk more about who decides, like, on credit ratings and so on? For example, okay, we talked about the IMF, but what is the role of credit rating agencies in all of that? For example, some countries have AAA, some other countries have worse and worse ratings. So who are they, and how they decide, like, who's the country that you should borrow money to or not?
Yeah. Okay, so
just basic.
Yeah. So basically, with this new architecture of the global economic system from the 70s, 80s onwards, there was a shift on where the states would borrow from, and in particular from the 70s and 80s, in the core capitalist economies, they would borrow more and more from the financial markets. And now it's a shift that is still going on. Also in the global south, you see more and more. I read recently about the news that Egypt is again, because it's not the first time in the recent few years, is again going to borrow on the financial markets in 2019 for.
And what does that mean?
So yeah, that means basically that you don't borrow at a fixed rate from a known creditor, but you issue bonds.
Okay.
So the state has the power to issue a bond which is going to be sold on the financial market to whoever, but basically it's actors. I mean, I don't think that anyone in the room buys bonds, sovereign debt bonds,
yes,
on the financial market. So it's basically actors that speculate. So corporations, yeah, mainly corporations or
hedge funds,
the richest households, etc.
And the shift, you're talking about the shift.
And there's a shift
Egypt.
because okay, so nowadays in Egypt, but I don't know about the exact rules in Egypt. But for example, if you look at the European Union, the sovereign states, the member states of the European Union, they have no other solution than to issue bonds. They cannot finance themselves. They cannot fund themselves from their central banks or from the European Central Bank. It's basically forbidden by the treaties. And even before the European Union, it was already banned in most of the countries because of this shift. And it's really a political shift, basically.
Yeah.
It's a political choice that was made in the 70s and the 80s to basically go beyond the crisis that happened in the 70s without dealing with the consequences. So basically, they didn't want to accept that, okay, some capitalists had to lose in the 70s, like they had to lose. That's basically what happens in a crisis. Some capitalists lose, and then there's a new cycle of accumulation that starts again. But then in the 70s, they did not accept that anyone loses, so they just found some new ways to open up for the accumulation of capital. That's also why this liberalization of the global south was very important for them. And yeah, so basically they decided, they implemented those policies that a sovereign state should not borrow from their own central banks. They should only borrow from private banks, which borrow from central banks. And what's the trick there is that a sovereign state is when it borrowed from its central bank, it could decide the interest rate. Could decide, okay, I will borrow 0%, maybe 0.025 or whatever. Here, the private banks borrow from the central bank to such rates. For example, I don't know, it's really small. It's like 0.05 nowadays with the ECB, with the European Central Bank. But then the states borrow from the private banks, and there come the rating agencies.
Oh.
And so, yeah, so that's why we say they borrow on the financial markets. That means that they don't decide their interest rates. It's the banks that decide them. According to the market value.
Okay. Those agencies are also like privately owned entities. They are not part of some, let's say, they don't have any political control over them, right?
Well, okay, so I think there's no invisible hand.
Okay.
So the market value is decided by someone, and indeed it is those rating agencies that decide about it. And here, so if you look at the Eurozone, it will vary from country to country. So it will be cheaper to issue some debt bonds for the core countries such as Germany, France, Belgium, the Netherlands. It will be more expensive for the peripheral countries such as Greece, Slovenia, Spanish State, Portugal, Ireland. The interest rates will be higher. And yeah, just to mention the absurdity of the thing is like, okay, basically, I mean, they borrow still. I mean, the idea is to borrow the cheapest rate possible. So I don't know, maybe 1-2% for the core countries, maybe 1 or 2% from the private banks, maybe if the situation is not that good, maybe 3 to 5%. But when the situation was really bad in Greece, they had to borrow to, I think the maximum rate was 17% or something like that. Yeah. And those rating agencies, okay, just to say that indeed they are private corporations, as you say, they are private companies that have private interests that basically want to make money. Okay. And their role increased a lot with this financialization, with this neoliberal phase from the 70s, 80s. And to be honest, I'm not an expert in rating agencies, but what I know is that before the 70s and 80s, who would pay the rating agencies would be the potential buyers. So a potential buyer of a bond that has been issued goes to the rating agency, asks, okay, what is that bond worth? I mean, shall I pay that much or that much? Okay. And which makes sense in a way. But then, with this change to financialization in the 70s and 80s, and I could not tell you exactly how or why, but nowadays, the people who pay the rating agencies are the actor that is being rated is also the client, so they pay the rating agency. So of course you can see an obvious conflict of interest, yes. Because if a corporation wants to be rated, I mean, they are the ones who pay, and they want to have a good rate. They have they want to have a good grade. So of course the rating agency can't say, okay, I'll give you a C- or whatever, you know. And it was made very clear. I mean, it may seem a bit abstract, but it was made very clear with the last financial crisis in 2007, 2008, where Lehman Brothers, so the first U.S. bank which went bankrupt, which was not bailed out, they were rated. They had the best grade. I think they had a AAA right before the crisis. And I don't know if you saw that movie, The Big Short. Yes. It's a U.S. comedy on the financial crisis. It's really good, I think. And there you can see how the rating agencies delayed the making public the fact that there was a banking crisis. So because they wanted their big clients, those big banks, to get rid of the liabilities, to get rid of all the risks that they had in their portfolios, because they were such big clients, they should get rid of it. They should sell it to dummies who would buy it because it was rated AAA, of course. And then they said, oh, by the way, there's a banking crisis.
Yeah. So now we can maybe talk about how have the private debts become public, the bailout and so on. How that happens, and what are the consequences of that? Is it really necessary to bail out them and so on?
No.
Are they are they too big to fail, as they say?
In a way, okay. Let me check. I had some notes. Okay. I think maybe to understand this question, it's good to understand the whole shift that happened in the neoliberal phase. Okay. So, yeah, basically you've got in the neoliberal phase, you've got the opening up of new fields for accumulation of capital, and this translates mainly in financial capital, finance capital, becoming the dominant form of capital in the economy. It doesn't mean it's the most important. In fact, I think it's useless. But it became dominant. It became the most dominant form to accumulate capital for capitalists. And this led to an increase in the share of capital in the national income of each state, and a decrease in the wages. So basically, basically that means that in relation with the growth of the economy, the wages went down, and the share of the capital went up. So basically, workers or people, most of the people became poorer, became more poor. And yet, private consumption continued to rise. How? Well, through private debt. So there was an increase in loans, consumption loans, like people getting loans to buy their car, mortgage loans, people getting a loan to buy their house, the place where they live. So that was the main change in the architecture of the global economy. And as I mentioned earlier, the financial capital, by increasing its profitability, it also increased its power. So it became the most prominent actor in sovereign debt issuing, etc. But I already talked about this. An expression of how it was possible for financial capital to become so important, to become so powerful, is also that they basically merged the different financial activities. So they merged what we call commercial banking, which is the banks that we have to deal with every day, with investment banking, which is the bank that invests in financial assets, etc. They merged that together. They merged it also with insurance services, for example. So now you've got this what is called universal banking.
Okay.
And in fact, the main banks, I don't know how it works here exactly, but the main banks, most of the time, you can open up an account. You can open an account there, but then if you talk too much with them, and I think you should not talk too much with them, but if you talk too much with them, they'll tell you, oh, by the way, do you have an insurance for that, and you want that. They called me the other day. I didn't answer. But anyways, so banks basically. Why am I saying this? Is because banks, they dealt with regular people, with us, with our money, and at the same time, the same banks dealt with way more risky activities, assets management, financial investment, etc.
So what you're saying, they spread out to more spheres of life?
Yes. So they spread out to, the same banks spread out to all spheres of life, to our spheres of life, yes. to the spheres of material life, basically. But also they took more and more risks in the field of speculation.
Okay.
So so in a way, it was more and more risky. There was a risk that they would fail, and in a way, it is true that they were too big to fail. I would like them to fail, but basically, if they did fail without any regulation, any overseeing on it, it would have an impact on the real economy, people. And it did have an impact, in fact, in the last financial crash.
I know that a lot of pension funds and so people literally lost their pensions.
Yeah.
That they were saving up.
Yes.
Privately owned funds.
Yes, and if you look more generally speaking, the economy is still running extremely slow for the last 10 years, and it's still due to the crisis. I think they have barely reached the same growth levels as before the crisis, and already a new crisis is looming. But so just to challenge this issue of too big to fail, indeed they had. Those banks, they were having very risky behaviors, and at the same time they were active in the real life, and that's why the states said that they are too big to fail. So this famous expression that we can't let them fail, and that led to the states having to thinking they have to guarantee that those banks cannot fail. And this led to the massive bailouts 10 years ago. That basically, when the banks went bankrupt, the state intervened massively, and they recapitalized. Is the word. They injected a whole lot of money in the banks, and when the state injects money in the banks, it means that it injects public money, and that's why we basically talk of what you just asked me of, like how those private debts became public debts, because basically we saved the banks for their risky behaviors, for their private debts, and they were what we call socialized by putting a whole lot of public money into them, and basically the debts transferred from the private banks to the public state. And then indeed, as you mentioned in the introduction as well, the state said, well, now we have to pay and we have to tighten our belt and to implement austerity policies.
So, yeah, we already talked about, in a way, how state finance is basically going to IMF and tightening the belt. But can you tell us now more about, a little bit about what is the committee for the cancellation of the third world debt? What do you do? What are your goals? And what are your successes and maybe failures?
Okay. Yes, so I'm a member of this organization, which changed name 2 years ago, by the way. So it used to be called Committee for the Cancellation of Third World Debt. It was created in 1990 during the third world debt crisis, or during the debt crisis in the global south. And at the time of rising movements of like alter globalization movement, or what would become known as the alter globalization movements, challenging this new neoliberal globalization. In 2016, we changed our name to a Committee for the Abolition of Illegitimate Debts, because it expressed also a shift that after the 2008 crisis, mainly in the places where we exist in the global north, we are now mainly focused on those places, because the debt issue came to those countries. Even in, so it's obvious when you talk of Greece, for example, or the Spanish state or Portugal, but even in the core countries, even at the time I was in France in 2008, 2013, I was in France. Now I'm in Belgium, but even in those countries. Even though the debt is not such is not such an issue as in Greece or Portugal or whatever, still the politicians, the decision makers, they still justify the austerity policies by saying, well, but look, we have accumulated way too much debt over what we can afford, blah, blah, blah. So they still use this, basically the argument of the sovereign debt to legitimize austerity measures. So we challenged that, and also, so that's why we changed our name, and also well, as was a bit mentioned, I mean, basically the sovereign debt crisis was first a private debt crisis, and was a private debt crisis not due to the fact that normal people they just don't know how to deal with their money and they just borrow too much debt and then they can't repay. It was a private debt crisis because of the bank's behaviors, because of their rapacious. Can you say vulture behavior? Like
vulture behavior.
Like because they were seeking profitability. Okay. So we also try to engage with private debt issues. For example, huge student debt issues in countries such as the US, Canada. Also, there was huge social movements a few years ago. Huge student movement in Chile as well. There was a huge student movement in Britain, where there was also a huge student movement, and then mortgage debt as well with countries such as the Spanish state or Greece. I heard that there's also things going on here in Belgrade or in Serbia, but like fighting against evictions due to the fact that you can't pay your mortgage debt. So these are things we try to engage with, and mostly we try to link with already existing grassroots movements that are tackling these issues. So
were any of them successful in abolishing that?
So okay, we were born in Belgium, in Europe, but from the beginning the idea was to build international links, and we had some international links from the beginning, and now we built an international network that is mainly present in Latin America, in Africa, in Europe, and a tiny bit in Asia. And I think, yeah, one of the reasons why we are quite present in Asia and Africa, of course, is because sovereign debt there was quite a burning issue in the 80s and 90s in particular. But nowadays it's coming back to the fore. And for example, in Latin America, we were involved in the experience of debt audit of Ecuador. In 2007, 2008. So basically, you had those countries, in particular in Latin America, but also in Asia and in Africa in the 80s and 90s, which were going through those huge debt crises, and these fueled, in fact, resistance movements from the grassroots in all those countries, which would later be known as the anti-globalization movement. And so in the end of the 90s, you had this huge campaign all over the world called Jubilee 2000. There were some Christian organizations in there, so that's why it was called Jubilee, because I don't know, according to some Christian tradition, I can't remember how many years the debts are supposed to be cancelled or something. Yes. Whatever. I mean, there was a huge campaign for the debt cancellation of the third world. It was very easy to say that it should be unconditionally cancelled, like 100% cancelled, because it basically fed itself. Like, I mean, and it was also, I mean, the debt fed itself. It grew by itself, but also the very origins were neo-colonial. So, so it was quite easy to argue for the cancellation. Anyways, in Ecuador, as in other countries, in the end of the 90s, there was this huge social movement demanding the cancellation of debts, and then in 2007 came to power this new president of Ecuador, Rafael Correa. So he was coming from the left wing. And in fact, he appointed as finance minister, he appointed the leader of the anti-debt movement. And this guy, he summoned an international debt audit committee. So basically that would be a committee that would audit the debt, that would investigate the debt, to know where it came from, how it was accumulated, who profited, basically all the questions that you ask, who profited from it, etc., and to challenge the legitimacy of such debts. And then the commission gave a report which was saying, okay, the debt that we analyzed, they did not analyze 100% of the debt. Don't ask me why, I don't know. But the debt that we analyzed is illegitimate for that and that and that reasons. And they had basically strong arguments. I mean, okay, in the end, for me, challenging the debt issue, challenging the sovereign debt or the debt in general is one lever, one means to tackle capitalism. But I think it's an operational. It's an effective mean, it's an operational means for different reasons. One of them is that even for liberals, even for people who believe in the current system that we live in, they understand that some of those debts should not be repaid, or at least, no, we have to convince them that they should not be repaid, because they can understand that they were not supposed to be from the beginning. And that's basically what the committee for the audit of the debt of Ecuador said, that the debt was illegitimate for various reasons, and they made a very strong case about it, and they gave very good arguments. And in the end,
was it cancelled? Well,
it was cancelled in a way. So basically, there was a technical trick that is that the government did not say, okay, we just cancel it and that's it. They said, after the report, they said, okay, we will suspend the repayments because we believe what is being said in the report is true, and we will cancel the debt. And then there was there was that launched a kind of how you say a struggle between the creditors and the debtor state, in this case Ecuador, and Ecuador held firm, and they were saying that well, this report was quite clear, the debt is illegitimate, there's no reason that we pay it, etc. After a few months, after like 8 or 9 months, basically Ecuador had argued, had maintained their position so firmly that the creditors thought, okay, let's just get rid however we can of that, and the Ecuador was thus able to repay to rebuy their debt with a 65% haircut. So basically they bought how much was it? Yeah, $3.2 billion of debt for $1 billion. So they economized. They economized 2.2 billion plus the interest. So altogether they saved $7 billion. They said, then the government, Rafael Correa, said he would use it for social spending, for social expenditure, for programs for the poor, for education, for housing, etc. To be honest, I don't know exactly how the money was used, but what we know is that, okay, nowadays the government, I mean, okay, Correa is not in government anymore, but even when he was still in the government, in the end he had taken a right turn, a right shift. So again here, I think that's why I say that to me that is one lever, one means to tackle capitalism, but it's not sufficient in itself. I mean, you can't just say, okay, we abolish the debt and then all the problems are solved.
It's going to accumulate again, in a way.
Yeah, it's going to accumulate again, and there's a whole, I mean, then you need to change the structure of your economy, of the mode of production of your country if you really want to implement something that works, that is fair.
So yeah, we are going to have just 2 more questions and then open to audience. So can you talk about a little bit what are the current trends? What are we facing a new crisis? We hear a lot talk about the new crisis looming. So yeah, what is the current situation as you see it? And is the crisis going to happen, and when?
So unfortunately, I very much think that the new crisis is going to happen. More or less soon, but what does that mean? I don't know. We've seen signs accumulating of potential situations leading to a general debt crisis. I think the main thing to understand here is that, and I think it's a huge problem, is that after the 2007-2008 crash, nothing was done against the way that the banks work. The management of the bank was not put into question. The shareholders of the bank, their decisions, their behaviors, they were not put into question. And that's a huge problem. There was no prosecution, even though there were actually illegal actions that had been taken by the bank managements. No banker was prosecuted and put in prison, except in
you say only one man was in.
As far as I know, no. Wait. So
there was some low-level guy, I believe.
Yeah. Okay. Yeah. Okay. So there's low-level guys have been prosecuted. There was this this guy from France who basically triggered the crisis, but it was going to happen anyways. Who was condemned to I don't know how many billions and years of prison, and then he was released. But anyways, but there were low-level executants, in fact. But the in terms of decision making in the bank's management, as far as I know, no one was condemned except for other things. For example, very recently there was a Spanish guy, a former head of IMF, Arato, his name is, who was condemned, but for fraud in Spain, not for his actions in the crisis. Only in Iceland there were some prosecutions, and some bankers from the bank management were put in prison. But that's it. Apart from that, some banks had to pay fine, but those fines, they were ridiculous compared to the money that the banks make in just one day, for example. So basically, what's important here to understand is that even though the crisis that happened 10 years ago was considered and is still considered by everyone as the biggest crisis since the one from 1930s. Basically, no structural change happened to prevent such a crisis from happening again. So all the same mechanisms of financialization that I talked about that were happening from the 70s, 80s to 2008, they are still happening now, and they are happening more than ever. And if you look at the current trends, for example, one very alarming issue is the rise of corporate debts all over the world. And I had this figure of I think it's U.S. corporate debt that rose. I mean, between 2010 and 2017, it rose by $7,800 billion. So it's like, I don't know if you can imagine the number of zeros that you have to put after 7,800, and that's the amount of corporate debt that was taken by U.S. corporations since 2010. And with this debt, what did they do? They did not invest in the real economy, in the productive economy, or barely. They basically bought back their shares so as to give a revenue to their shareholders, which would be tax-free. And they invested in other corporate debts, like in the debts of smaller corporations, and the more risky the better, because for them, what they are seeking is profitability. So the more risks, the better for them, because it brings more money in. So there's this huge corporate debt, and by investing in the debts of other corporations, they are building again a chain, a crazy chain, which means that when a few corporations will suddenly stop paying because the bubble will burst or whatever, then there may be a chain reaction that would trigger a crisis. And there are some signs. If you look at what happened in Turkey in the summer, for example. So basically, in Turkey over the last few years, the economy has been driven by what we call debt-fueled investment, debt-fueled economy. Like there was an increase in the economy in Turkey, in particular in the real estate sector, but was fueled by debt. And then in the summer there was this geopolitical crisis with the US, and the Turkish lira went down. So basically, the debt that those corporations owe to like foreign debt, which is often denominated in dollars, it was suddenly much higher. And then so it does create some tensions. For now, it has not exploded into a generalized global crisis, but these are some signs that should lead us to think that something is coming, unfortunately.
So the last question, of course, is what is to be done, or what is the alternative?
I mentioned as CADTM, I mentioned as part of our experiences the debt audits. I think it's the main tool that we put forward. Also because what we put forward is not just a debt audit being done, for example, by MPs or whatever, which can be done, or by technicians of I don't know which private corporation. But what we call for is what we call citizen debt audit, which is basically a militant debt audit that basically we say it should be a democratic exercise that everyone, the citizens, the workers, they should be allowed to look into the accounts of the state, of the public entity in which they are. It can be the local city council. Basically, there's this old demand in the workers' movement, which is we should open up the how you say
books.
the books of the company, the accounting books of the company. Well, it's basically the same for the sovereign debt that since we are being asked to pay for it through austerity measures or through taxation, etc., and which is not necessarily a bad thing. I believe that public investment is needed, and therefore maybe a fair public debt should be needed. But basically, it would be a democratic right to have a look into how and why the debts were incurred and who benefited from it, etc. So that's one way. That's one thing that we advocate for. And on this basis, to argue for the cancellation of debts that would be illegitimate. So to say it very quickly, in CADTM, in the movement that I'm a part of, but also based on the broader alter globalization movement, we propose four types of debts that should be considered as illegitimate and cancelled. There's what we call illegitimate debt in general, which was of no use for the public interest, but was used for small private interests. For example, bailing out the banks after the crisis 10 years ago. There's unsustainable debt, which is before that there's illegal debt, which is a debt, it's obvious, which has been taken without the formal rules being followed. So for example, in a lot of states, you can see in the constitution that the parliament is supposed to agree with a new debt contract, and in fact nowadays debt is just like business as usual, so most of the time parliaments don't even look at it. So that's another thing. Then there's odious debt, which draws on a debt doctrine which was written by a conservative jurist, so a conservative lawyer. So it's interesting to see that, okay, even from the conservatives, you can find arguments and you can use them in this fight. So odious debt is basically an illegitimate debt that the creditor knew that they would not serve the interests of the general interest. And then what we call unsustainable debt. Unsustainable debt is a term that you can see often in the main institutions such as the IMF, etc., where they say basically an unsustainable debt is a debt that grows bigger and bigger by itself and that you can't repay. We think it's a bit too narrow, and for us, unsustainable debt is basically a debt that you can't repay without impinging on human rights in your population, and that's very often the case, in fact. So yeah, so the debt audit to cancel the illegitimate debts is one thing. I think another important thing, I mean, there would be, of course, a whole program to be listed, but I think another important thing would be, but maybe we can discuss it in later on, yes. Would be to change the structure of the banking system, and basically we advocate for the socialization of the banking sector. You can say nationalization, but the idea is I mean, okay, I would not like a bank to be nationalized. I mean, in fact, in the last 10 years, there have been banks which have been nationalized, but in the end, their management was also not put into question because they were nationalized by capitalist states. So if a bank is nationalized by a capitalist state or by a bureaucratic state or whatever, what's the use? So that's why we prefer the term socialized to highlight the fact that the banking sector should be put at the interest of and the public interest, that it should be run by its employees, but also by its users, etc., by its customers. And also it should be decentralized. I mean, we should absolutely forget about huge banks taking lots of risks everywhere. We should have small banks and also separate commercial banking from investment banking, etc. But you should have small banking units decentralized everywhere, so that basically we could decide democratically what is to be done with the finances.